Tesla has, in our research product, had been appearing since inception, since 2019, because that company has a hidden asset, which is its AI and intellectual property. And now, of course, the intellectual property built around all this infrastructure they own. So it's a company that to us looks undervalued because people look at it as a car maker and look at current margins and earnings. But as we know, there's a lot of new initiatives, whether it's robotaxi and
as a result of the company's hidden asset, its AI and intellectual property, and of course the intellectual property based on all of this infrastructure, Tesla has been featured in our research product since its beginning, which dates back to 2019. Because people view it as a vehicle and consider its present margins and earnings, we believe that the firm is undervalued. However, as is well known, there are several new projects, including robots and robotaxis. We are aware that the market is rather apprehensive. It is evident in the credit markets, which is where the decline in Tesla bonds started. Additionally, I believe there are some reservations regarding how they were carried out. But take a peek at their devoted clientele. Their CEO is quite charming. In certain respects, I do believe Tesla will emerge from this fine. I believe that investors need to witness some execution before they feel at ease, since it has become somewhat similar to the Missouri stock, a show me stock. However, given the significant downturn, now is the moment for anyone who is truly positive to get into. Because of what they're doing, I believe Tesla has the potential to become a revolutionary business in 10 years. Therefore, Tesla may be a fantastic chance here if someone does look ahead 10 years. I mean, I believe Tesla has everything it needs to become a truly revolutionary business. Profits for corporations are high, they are speeding up, but this is happening while demand is actually very strong, isn't it? The top line is growing at about 8%. Additionally, I believe that consumer spending and housing demand, two factors that propel future growth, are robust. Therefore, I believe that it is a good moment to buy stocks since everyone is a little anxious and afraid, and there is some geopolitical risk. If you're long-term focused, now is the moment to increase your exposure to stocks. The research technique we employed at Fundstrat is essentially the foundation of the Granny Shots ETF. We had been employing the thematic core stock portfolio since 2019. For 6 years in a row, it selects 7 topics that we believe are pertinent to the market and determines which stocks are most associated with those themes, whether AI, millennials, Fed easing, or increasing PMIs. Then our Granny Shots are the stocks that show up most often across theme. Additionally, Granny Shots is called after the free throw shooting style of Hall of Famer Rick Barry. It's not enough to merely watch Tesla's remarkable rise from the outside. With the most recent information on Tesla's stock price targets, innovation, and all things Elon Musk, Seeking Alpha is the one-stop shop for Tesla bulls and those with an eye for finding the next big thing in the stock market. Our channel may get a commission if a customer makes a purchase after clicking on the affiliate links in the description. Investors ought to consider it an essential position for their portfolio, in my opinion. The Granny Shots is essentially a thematic portfolio that purchases the best stocks within a certain subject. Apple, Nvidia, and Tesla are, in my opinion, at the core of the AI and millennial phenomenon. Investors should be aware that tiny caps are hindered when they are concerned about their lack of visibility. The IWM has outperformed the overall market when the Fed starts to make cuts, and we have demonstrated this to our clients, and the number of anticipated cuts starts to rise. In actuality, the stock market is stating, look, until the Fed starts cutting, I don't want to touch small cap. The median P/E multiple is really about 10 times in the Russell 2000 compared to 16 times for the S&P. And small caps have superior profits growth in the interim, nearly 19% in the Russell 2000 vs about 9% for the S&P. Therefore, smaller multiples and higher growth. In my opinion, investors currently have an excellent risk-reward ratio. This is the current situation, which is a greater cost of borrowing money, or the high bar that thus begins to relax when the Fed begins to reduce. What would be advantageous to investors? It involves being exposed to assets that are linked to improving financial circumstances. In fact, that would support tiny caps. It is therefore kind of a waiting game. However, I'm not aware of anyone who has made money while attempting to trade on a weekly basis. Great ideas, all of them, require time to develop. One issue, though, that I believe investors should be aware of is that they may see a small cap firm as being weak. In reality, though, small cap firms, particularly those in the Russell 2000, tend to be extremely powerful businesses that control a narrower market. Because of this, they may be the most successful firm, but they are not a trillion-dollar corporation. It's only a matter of time, I believe. Part of the reason for this, in my opinion, is that there's a lot for investors to process between now and the next month, which is around election day, including rising oil prices and an inflated VIX. I want to be buying outright between now and early November is something that I believe is difficult for someone to state these days. Therefore, I believe that tiny caps still have solid foundations. The rise of earnings is speeding up. At 11 times, the median P/E is nearly 7 times lower than the S&P. The argument that tiny caps are beginning a multi-year increase is still valid, in my opinion. It has simply been extremely erratic. Over the past 6 weeks, the stock market has demonstrated its character, which it has maintained throughout the year. This year, the S&P is quite strong. Now, it has been up for 9 out of 10 months. And we were duped by seasonality because I reasoned that there was a greater chance of a correction of some kind between now and election day. You want to sell stocks was not what we were saying. Panic selling, in my opinion, is always a mistake because, as we've stated in the same line, but if it does pull back, you want to buy that dip. And until after election day, I believe we're still in that precarious situation. However, that does not imply that I believe investors should be pessimistic at this time. We have a solid foundation, in my opinion. Look, the economy is greatly aided by a 3% Fed funds rate. It will significantly lift durables, houses, and automobiles out of a recession, and it ought to benefit P/E multiples as much as earnings growth. Therefore, all of this seems like a fantastic background to me. However, that does not preclude the possibility of turbulence. Therefore, Jay, I believe that many consider the possibility of caution to be a pejorative term. It shouldn't be. This is the stock market, after all. And if there are dips, people should be ready to purchase them. As you are aware, a lot of investors and analysts believe that as inflation decreased, it has been reduced in half over the past 2 years, that sales growth would not only stop, but profitability would also stagnate. Instead, this quarter's S&P sales growth is expected to exceed 5%. And that's more than plus 2% on a real basis. And that's in fact, it's among the best figures in over 2 years. Therefore, thus far, this earnings season has been of very high quality. And, profits are so far exceeding earnings by over 80%, if not more. Therefore, this is a good beat season. When the financials were released last week, they were, generally better than anticipated. And thus far this year, financials are performing quite well. However, industrials are the other category that is most vulnerable to the Fed's cuts. Additionally, a fifth of the S&P is made up of industrial reports this week, but so far, so good, I would say. And once more, despite an ISM that has been roughly at its lowest point over the past 2 years, industrials are doing well. You see, this market peak will not occur because of a recession or because someone will experience a P/E issue. I believe it's quite possible that either firepower will run out or expectations will become unbalanced in the next 6 months. We could measure markets as well, right? We may examine the margin debt, which has been flat over the past 4 months. As a result, most investors have been reducing their risk and the market has been rising. For me, that is upside gasoline. Furthermore, emotion readings show that it is not excessive. The VIX was indeed high and just returned to normal yesterday. As you are aware, solid fundamentals underpin bull markets. In this instance, the economy has not only managed to withstand exceptionally high interest rates, but the Fed is also starting to lower rates. And China's economy has been kind of sluggish lately. Additionally, that region is being supported by some stimulus and what appear to be bazooka measures. We also have a substantial amount of money on the side. In my opinion, this is a methodology that will help equities perform well over the next 3 to 12 months. We believe that we will surpass 5,700 before the year ends because of this.